Um, we're live with question number 5, so we can begin.
Good day and welcome to Sundaram Mutual's Wisecast series of webinars, under which we are today going to handle our fifth question hour, which is also the October edition of the same. So in this question hour, we're going to be covering two sets of topics. One is earlier this month, we did our usual EMI update. E for economy, M for the stock market, and I for your investment allocations, right? So thank you. Many of you have observed it. A lot of comments have come in and a phenomenal viewership for that. Then about a week ago, we did a special session this month on the sectoral performance. Again, using the EMI format, but the problem with doing a sectoral thing is that you got to wait for the data to come. And hence, this was a very appropriate time because all the quarter 1 results had come in, the markets had reacted to the quarter 1 results, and the guidance from the quarter 1 results was resulting in the index performance. So it was a beautiful time to do that. And again, that webinar got a very good response. And so today's question are, we have received a lot of questions from people from both the webinars, right? So I'm going to start off by just giving you an update on the economy and the sectors since our last webinar, and then go on to take on the questions. We're also ready to take questions live, so please keep them ready. So to come forward to the thing, as we said, this is a deep dive that we did into sectors on economy, earnings, and stock market. So at this point, let's first look at what is the update. And this is data as of yesterday, right? The stock market, as you can see, has been going through a very, very good phase ever since the March slowdown happened, right? So you can see green right across from 1 month to 1 year, right? And there are two different perspectives to share here, which I'll just strengthen with my next slides, which is that in the recovery, the small cap seems to have done the best, followed by the mid cap, and then you have the large cap performance, which is at the 1 year return level and at the 6 month return level. But you come to the 1 month return level, you see a different picture. Large caps are back in focus. The 1 month return of the large cap indices are 7%, but the mid and small cap are at 1.8 and 1%. So you can clearly see how the leadership position has been changing. And then you just, before we move on from this slide, if you look at the 3 year returns, you can see the dramatic, that is, the mid and small cap indices are in deep red, whereas the large cap is the one which is given strong double-digit returns. So as you can see, leadership has been fluctuating across time frames in the market, right? Now, one of the ways which we like to present data, and you would have seen this, those who have attended our webinars over successive months, that we look at the 1 year return as of March, which was the worst point of the market, and then you look at the 1 year return as of 22nd October, you'll get a sense as to where the recovery has by and large been. Now, despite the fact that in 1 month, the large caps have outperformed mid and small, you can see still that the leadership remains with the small cap, followed by the mid cap, and then by the large cap. So this number a month ago was looking much more sharper. It is toned down, but still remains that. So what accounts for this is one of the puzzles that we are facing, because we know the Indian economy is not doing great, right? With a 24% negative GDP growth, and hence mid and small caps, which are very closely linked to the domestic economy, have on the contrary been outperforming on the bounce back. So what is it that's there in this data? The devil lies in the details, and those details are the sectoral details. So for a minute now, let's look at the large cap sectoral breakup. So as you can see, the top segments of the large cap index, right? So that's where the whole relevance of sectors comes in. You see, banks accounts for 23% of the index, software for 17%, and petroleum products, because of that one company, for 16%, and then you have consumer durables. So if you look at it here and look at slightly below to auto and pharma, I will point out, just file this away in your memory, that auto and pharma together account for only 10% of the large cap index. Whereas when you come down to the mid cap sectoral breakup, right? Again, you can see that pharma is the top third. So finance and banks are much less concentrated in the mid cap index as compared to 22% there. And if you look at the finance part, is 10. So banks plus finance in the large cap is 36%. 34%, one third of the index, whereas in the mid cap index, banks plus finance is only 22%, only a fifth of the index. So what's here big? Pharma at 8.5% and auto at 4 or about 12%. So now you can realize my thought process here that the sectoral indices are what are driving your cap curve indices. And this point is brought through very sharply when you look at the small cap sectoral breakup. Pharma takes the leadership position with 15% here. And if you look at it, that is what has driven. So now when you look at the sectoral performance, right? Fund managers study and buy sectors before they study and buy stocks. That's what is accounting for this. And hence, now when you look at the sectoral performance, you can clearly see that in the 1 month return space, where I said large caps were dominating, you see banks have bounced back. That's the largest weight, whereas auto has only done 0.5%. Pharma has done only 0.7%. So the leadership change in the last 1 month is because again banks have started dominating, and IT again has done well, again a key component of the large cap index. So please remember always that it is the sector which drives the cap curve and not the cap curve that drives the sectors. That's one. Now when you look at then, you look at the 6 month return, there you will see the point I am making, that in the 6 month, the small cap outperformed the large cap, right? If you recollect, maybe I'll just show you that just for your jogging your memory, right? So in the 6 month space, the small cap index has delivered 40%, whereas the large cap has delivered only 30%, right? That 10% differential in the 6 month index can be understood when you look at the sectors. 6 months, auto, which is a significant component, is 45%, pharma has done 28%. So the sectors have driven the leadership of the various cap curves. This is even more sharply seen when you see it in our typical format of December pre-COVID, March COVID impact, October post-COVID. You can see the change in the thing. And so healthcare and tech have clearly been the ones which are now today on a 1 year return basis, given very strong positive returns. And that translates into the sectors. And so from a V-shaped recovery perspective, if you look at this graph, you will see that the number 1 and number 3 sectors in the V-shape are tech and IT, and number 2 is healthcare. So the mid cap and the small cap indices, which are heavier in the pharma, heavier in the auto. Auto also, if you see, has been the 5th rank with a 43% bounce back, right? So the leadership sectors of pharma, healthcare, and auto are the ones which have driven the small and mid cap indices in the short 1 to 6 month period since March to have jumped up. But in 1 month, it's again leadership is changing back into the safety sector. So there's a significant clue here on what the market is thinking, right? So I just wanted to give you some more updates in terms of since the last webinar, what data has changed. So only those slides where the data has changed, I'd like to just present before you. So in the manufacturing survey, the Philadelphia Business Outlook, which is the bluish one, and the ISM manufacturing, all of them continue their V-shaped journey. So the health of the US economy is clearly moving to a stronger wicket. Next, the Euro area, industrial production, France, Italy, Germany, Spain, all over there, you can see a sharp V-shaped recovery forming clearly. Next, in India, the electricity consumption trend, right up to 10th October, we have tracked it. You can see that the unlock and the revival of business is starting to show up there also. And the television ads index, which went through a little bit of a flat place with the IPL coming in, has seen a sharp uptick, right? So that's another update. And overall economic activity, which the same Jeffries conducts, if you see that there is a 93% pickup. That is, we are now back at 93% of pre-COVID levels. But remember one thing, that's not really fantastic, because pre-COVID itself, our economy was in the throes of a slowdown for the last 2 years. But all said and done, getting back to that is an important step in our journey to economic recovery, right? So that's the brief updates that I wanted to give you. As I said, we've received lots of questions. So I'm going to stop sharing this slide now, and I will refer to these as and when I feel the need to use data to support any of the answers to the questions. So the first question that we had received from the participants over the last 2-3 days is that pharma as a defensive sector did well. When is the time to exit? And what should be our exit plan? And what indicators do you keep track of? Very good question, right? So, defensive sector is a sector generally, right? And pharma is not the only one there. IT is another defensive sector. Is generally the one which does very well in a bad time, but doesn't do so well in a good time. That's the nature of defense in the stock market, right? It protects you from the downside, but naturally there is a price for that protection, right? That is, you don't get that much of the upside. That's the risk reward framework. Now, pharma has done well for two reasons. One is its nature as a defensive sector. That is, when the fall happens, you find that medically people generally don't stop their medical expenditure. So there is a defensive element to it. But in this particular scenario, the nature of the crisis being medical, pharma has actually changed its stance to go from a defensive sector to actually a growth sector, right? Because in the recovery from the COVID crisis, vaccine or a cure, its bulk production is going to be a huge, huge uptick for the pharma industry. Hence, for a period of time, this sector is turned into a growth sector and will continue for some time. So that's why the question was very good, because somebody's asking what's the time to exit. The time to exit a pharma sector will come when the vaccine has been produced, distributed, and the world economic recovery is back on track, because the fear of the virus is no longer a huge dominant thought process. That when that happens, pharma will go back to their normal lives. The vaccine production will sharply drop, and then is their normal defensive nature which will come in. That will coincide with the fact of the economic recovery, when other sectors, cyclical sectors, will start outperforming. So relatively, those sectors are. So that time, according to me, is about 12 to 18 months away, because the quantity needed of this drug is so huge that it will sustain the pharma industry for the next year, year and a half, according to me. So pharma's status as a growth sector will continue for 12 to 18 months, after which it will revert back to its defensive nature. So from that point of view, I think that's a good time frame to look at from when to exit the sector. I would say for the next 12 to 18 months, you'll still get healthy returns. But let me qualify those healthy returns by saying that the run-up which has already happened also means that you should not expect similar 50, 60, 70% per annum returns from that sector, but a decent double-digit returns is more than possible, right? So the indicators are this: the discovery of a vaccine, its execution, and the recovery of the world, depending on in which country that vaccine takes effect immediately, and there's a sharp V-shaped recovery in visibility. So I think you go to track the economic indicators only for that, and then make your decision of reducing your allocation to pharma at that stage. So when they say exit, I never get out of a sector completely. So it doesn't mean you put down your pharma to zero, because at any point of time, you have to have a blend of safety and risk, right? The risk delivers the reward, the safety protects you from the risk. So in the blend, I would say reduce pharma at that stage, but don't exit any sector in its entirety, because the safety element always has to be present in anyone's portfolio, right? I hope I've answered that question. The next question which came in is at the other end of the spectrum. Is it now a good time to invest in infrastructure? So obviously the person who asked this question is believing that the V-shaped recovery is going to be very rapid. I would caution you on that. The V-shaped recovery is definitely on the anvil, but infrastructure is probably the end result of a V-shaped recovery, right? So you got to have first, what has happened with the slowdown over the last 2 years and the COVID crisis and the lockdown has been that government's fiscal finances have got stretched, because income for the government has been steadily dropping. GST has been dropping, income tax collection dropping, disinvestments haven't progressed as well as they could. A 5G auction hasn't happened. So government, which is a leader in infrastructure, has a constrained space, because the fiscal deficit is already challenging, number one. Number two is the capacity that we built up in the 2013 to 17 period, right? And then the capacity utilization also was growing, started coming down from December 17. So it was around 77%. Our economy's peak capacity has been about 83% way back in 2011. 77 is where it went up from about 69 levels in 2013-14. But since then, it has dropped dramatically back to 68, 69. So capacity utilization being low, capital expenditure by the private sector is not going to happen in a hurry. So the way the V-shaped recovery will play out is consumption will first need to pick up. Capacity utilization need to go back to those mid 70s and early 80s, and then who can have a kickstart of private domestic capex. One, government capex. This budget is a clue. So if the government, in discussion with the rating agencies and the IMF, comes up with a very pragmatic plan saying, okay, we will live with a higher fiscal deficit for some time, but the rating agencies has to come in tow with us in terms of saying, okay, then the government in the budget can announce a good infrastructure spending plan on the capex. Then you'll see that their government's order book releasing into the public domain will lead to some kind of a boost. That's a third leg. And there's a third leg, which is when and not if of this third leg. It's a certainty to happen. That is foreign driven domestic capex cycle. That is the problems which China is facing structurally in terms of its labor declining, in terms of its per capita income already gone up, so wages being very high, and the COVID crisis creating a kind of anti-China feeling in a lot of the world, means that India, with the exact advantages that China's disadvantages are, means high supply of labor, low per capita income, will be in a pole position, and the government is doing its bit, reduced taxes, improving our ease of doing business, and most recently they announced plans for the electronic manufacturing through PLI, defense sector they are opening up, public sector they are opening up. So this will definitely lead to a spike in the FDI. Now India already has been on a rising trend on FDI, but most of that FDI has been going into the internet-based startups like a Paytm, like a Swiggy, Zomato, so that money has to start flowing into manufacturing. Now you saw April to September numbers of FDI released also show that it's much higher than last year. So good news. But for this to come into real manufacturing, right, will happen. It's a matter of when and not if. But when that happens is when the infrastructure cycle will really, really kick up, right? So I would say that from that point of view, right, it is definitely going to happen, but you got to wait for the announcements to happen, because the step is announcements of FDI, then government approving it under their licensing schemes, then they approve it, then those people concretize their plans and they set it up. Then you have the capital goods suppliers getting orders. So the capital goods suppliers from the small cap and the mid cap will start, and then the final infrastructure will happen. So I have clearly very detailed laid out the plan for you. So infrastructure, if you take a 5-year view, it's an excellent time to invest, but be prepared for a very bumpy, volatile ride for the next 18 to 24 months. So I would recommend that if you take the story that I've laid out and get convinced about the infrastructure segment in the medium to long term, then start an SIP or an STP from your money fund into the infrastructure funds over the period of the next 12, 18, 24, 36, whatever time frame you choose. Lump sum, I would say, wait for the signals to happen. So you can start an SIP today, and I'm sure that in 5 years' time, you'll be a much happier person on that, right? So that's my answer on the infrastructure sector. The third question has come on the side of another safety sector called tech. Now again, tech has boomed, the question I'm reading out, the tech has boomed quite a bit. Would you say the sector is overvalued, or can we still invest? Now, about tech, two parts to note. Something like I said for pharma about it being defensive holds good. Something that I said about pharma, that sector has become a growth sector in the short term, is also true for the IT sector. What is the reason for this? The reason for this is the COVID crisis and the lockdown has proved to be another Y2K moment. What do you mean by Y2K moment? You know that now 1999 to 2000, when it had to shift to the year 2000, a lot of the digits, the Y year 2K, right, had to change. It was a phenomenal boost for the IT. Similarly, the COVID has reset the whole business model of a lot of companies, right? Work from home is a part of the norm, right? Zoom webinars like these are a part of the norm, right? People who are now, location is no longer a criteria. Really speaking, because of this now, people will say, okay, I don't care where you're based, deliver the product. So data, the pipes for the data, and now the consulting work on the IT side to tell a company how best they can locate themselves geographically, deliver geographically, all of that is a huge change. And that's where the IT sector has taken very good advantage of this. And despite the headwinds on the H1B visa issue and all of those, we are seeing that the IT sector's actually order book is growing. So I would say that the run up in the IT sector is on the back of a strong guidance and strong performance. As you would have seen from the Q1 performance, IT companies have done well, and the future guidance from those bellwether IT companies is also good. They're announcing salary hikes back again, announcing bonuses. So clearly, I don't feel that despite the boom that's happened in the tech, that it has run its course. I think that it's got a good course ahead of it, and it is a more sustainable course than the pharma course, because pharma is very event specific, whereas IT is more fundamental. So I think that IT is a good sector to play for even a slightly longer term. But caution is, don't expect the returns that you got in the past to repeat. You should be happy with a decent double-digit earnings from any particular segment. And IT, I think, is in a good position to deliver that. And I would say that right now, the large cap ITs are the ones which are benefiting. It will filter down to the mid cap and the smaller cap ITs. And India, with English language and the engineering college base of graduates that we have, will continue to be a leader in the world in this space. So I would say continue to stay with your allocations in IT, and it will not disappoint you in terms of, unless you're expecting some 30-40% kind of return. Don't have those kind of expectations, but decent double-digit returns are quite possible. So I would say stay invested in IT with a decent allocation, right? So next, somebody has a question about should we invest in Indian large caps or in global brands? So Indian large caps are benefiting from the fact that the COVID crisis hurts large cap much less than mid cap, small cap, and micro caps because of their size, right? That size matters. Second is within large caps, right? If you use quality filters, you will find that they have resilience in the downturn and can capture market share in the upturn. And in fact, such downturn times are opportunities for large cap to grow even bigger through the inorganic route of mergers and acquisitions, right? So large caps will grow stronger. So Indian large caps, because Indian economy went through very sharp slowdown, are in very good position to capture all of this. The second interest in the large cap space is they have access to a huge pool of money from FIIs, which mid caps and small caps don't. So there is a safety element that as long as India's growth story in the future, the V-shaped recovery looks proper, Indian FIIs investing into Indian markets will naturally buy Indian large cap stocks. So I would say Indian large caps continue to be a good space to invest in. Now, the question you asked was in relative comparison to global brands. Now, global brands, what is the story? Most global brands are listed in the advanced country stock markets, but their business is dominantly in the emerging market space, right? So global brands actually benefit from the Indian economic growth, but their result is seen on the American stock market. Take McDonald's, take Google, take Facebook, take Apple, you name it, right? They're all there in India, and India with almost 400 billion middle class, right? It's going to be a huge 400 million, sorry, not billion. It's going to be a huge market for them. So that part of the consumption which happens in India, in China, in Brazil, in Russia, does not go into those stock markets, will be reflecting in the earnings of these global brands. So for you to benefit from Indian economic revival, it's essential that global brands be a part of your portfolio, right? Second aspect to global brands is because they're listed in the advanced country stock market, in any FII flow, it first fills their home country and then only goes searching for risk, right? So these stocks will actually benefit because of the money flow. And as you know, the US has promised to keep interest rates low for 3 years. $13 trillion of liquidity continuing to be pumped into the world, advanced world economies. So I would say global brands, and the third element to global brands for an Indian sitting in India is that Indian currency. In the short run, it may be appreciating, but the long run direction is between the difference in the inflation between, let's say, America and India for the US dollar rate, or the difference in interest rates. Because inflation is hard to calculate, but we know that American inflation is far lower than Indians, yes. But the interest rates tell you there's a 5% difference. So if you have a longish view, over the next 3, 5, 10 years, right, which is ideal to invest in global brands, you will see that the currency depreciation, which is fundamentally inherently 5% per annum. If you take the last 10 years, it's been 5%. The last 5 years, 3 to 5%. So that factor will add you to your portfolio if you're an Indian investing in a global brand fund. So I would say that you have to do both. If you ask me, Indian economy is going to recover, so foreigners are going to be interested in India. At the same time, Indian economy is going to recover, so global brands present in India are going to benefit. Monetary flow into equities is going to bounce back. So it's good to have both in your portfolio. I'm not going to say choose one or the other. I'm going to say choose both. Right? How much allocation you should do? 50-50 is a good way to start, because that's the right way to approach the whole business, that within your large cap allocation, put in 50% into domestic large caps, put in 50% into global brands, which are all super mega large caps, right? So that is that question. Next question, part of this I've answered, so let me just take it up though. What themes to invest through SIPs? So the infrastructure theme is ideal, right? The next theme would be from a thematic perspective, banking, because banking with recently is recovering, but over a period of the last 1 year, its 1 year returns have been damaged in the COVID crisis, the fear of NPA, moratorium, and all of those coming up. So I think that the recovery of the Indian economy will be matched by a greater recovery in the banking segment. So I think doing an SIP into a broad fund, that is banking and financial services fund, don't restrict it to banking, but banking, financial services, insurance, asset management, wealth managers. So a broad financial services fund would be an excellent time to start an SIP in. Infrastructure is one, and BFSI as a gas, is it better to start investing in renewables? See, renewables are a decent bet from a very, very long-term perspective. But what has damaged the renewable story a bit is the drop in price of oil. So you see, ultimately, commercial elements are also as important as thought processes. So that definitely the thought process towards renewables, green energy, not polluting the planet, and so this ESG funds and all which have come up. So there is definitely a wave happening towards that. But end of the day, you have to make money, right? So when you have low price of oil, a person intending to switch to renewables will say, I'll do it a couple of years later. No, right now I'm getting cheap oil. $80 I bought oil, today $40 I'm getting oil. Straight away it's a bottom line positive, right? So to push the renewables, the governments have to give even more subsidies and everything to directionally push it. It's a good direction to go in. And I would say renewable energy, the capex that goes into building renewable energy for the future is a better bet than the actual renewable energy sector, right? So you have solar, energy plants. What are the suppliers to solar energy? They will see an opportunity because people will start investing in renewables. But for the renewable sector itself to be a profitable sector from a stock market perspective, give it a bit of time. So I would say it's still early days. And so maybe you start with a small allocation into that now, and then you can build it up as you see the story planning out, right? So when do you expect the slump in the automobiles to pick up? So automobiles, while I did refer to it myself in my presentation, is not a monolithic single segment. Auto has three clear components. Okay. So the first component, or say actually four components, if you ask me, from the auto sector. Right. So the first component is the actual end automobile. So where you have the retail passenger vehicles, which is two-wheelers, cars, whatever, right? That's one. Next, you have the commercial vehicle segment, right? That's the trucks, LCVs, MHCVs, three-wheelers, all of that. Then you have the agricultural auto, the tractors, the power tillers, and all of those, right? The fourth segment is the auto component segment, right? So these four all operate in are in a different stages of play. So let me go through them one by one. Let me start with the agri. Because of the good Rabi harvest, the good monsoon, the supply of migrant labor available in rural India, the Kharif sowing being good, tractor sales are already at double of last year's. So tractors are already recovering. So the good monsoon and the forecast, and now with the harvest coming, the tractor demand will continue. So that agri component of automobiles is already on a good wicket. The recovery is happening. Then I'll come to the rural retail vehicles, the passenger vehicles, two-wheelers. There again, most of the demand comes from Bharat, that is rural India. And rural India was protected from the virus. In the middle, we saw a spike, but now the curve is bending. All of this money due to Rabi harvest, Kharif harvest will lead to a good. Plus, we have a Diwali coming, which is the time that people generally do. So, if the virus doesn't spread out and bring it under control, this Diwali could be the trigger. Already, I think it's about 70 to 80% of last year's sales, the retail passenger sales have come up to. So I think with Diwali, you will get a good boost. In January, with Baisakhi and Pongal and the harvest, you will get a further boost. And then March, you will continue to get the boost for depreciation purposes, right? So those next 6 months, I think you will see the retail passenger vehicle segment really getting back on track. That's one. The third segment is the commercial vehicle segment. That is where the challenge is for the auto, because the commercial vehicle has been on a slowdown well before COVID. And what is the slowdown due to? It is due to the implementation of GST and those axle modifications that the government did, and the tax that the lifetime taxes on the regulation. Right? So all of those came as a whammy to the auto sector, the commercial vehicle space, and that sector went in. What is the GST impact? The GST impact is earlier a truck going from Chennai to Delhi had to stop at every check post, fill out the papers, RTO, some under the table payment, something led to a delay. So it would take, let's say, from Chennai to Delhi 7 days to go and come back. With GST, one India, one rate, no stopping at border checkpoints, through traffic, that came down to 3 days. So the existing commercial vehicle base already built up was more than adequate to cater to any growth, which was anyway slowing down. So there's a double whammy that growth was slowing down because from December 17, our economy went into a slowdown. At the same time, capacity was excess, so fresh commercial vehicle production collapsed, and hence it's in a deep cyclical slowdown. When will it come back now? It's going to take time. As the economy goes into V-shaped recovery, the existing trucks have to see a greater haulage, greater usage. And then when that capacity comes up, we'll see fresh production again start, and then the fresh capex. So that's in a very deep shaped cyclical downturn, and I would say at least 12 months it will take for that segment of it to pick up. Finally, the final segment being the auto components. These are the spare parts and the suppliers. Now, to the domestic, again the same story. Spare part suppliers to private vehicles, tractors, that should pick up. Commercial vehicles, well. But more important, there's a third leg to this whole auto component, which is that it's an export-oriented segment. So, from an export perspective, the V-shaped recovery of the world should probably lead to some amount of an uptick on the export component of the auto components, right? So, I hope I've given you a very detailed answer. So, you have to look at it within the segment as to which companies take it to which segment to see who will recover faster. Right? I hope that answers your question. The next question is on, can we expect leisure and hospitality to pick up mid 2022? Now, mid 2022, leisure and hospitality, I would say tough, because I would say that the people, the fear of the virus in terms of travel will persist for a few months into the new year. So mid 2022, you will start to see the green shoots of the fear. And for that, the vaccine is important. When a vaccine comes, people get vaccinated, their confidence to travel will go up. So if a vaccine is brought in, administered, then what you say can happen. But my own sense is, given the huge need for it, I think the vaccine situation is going to take quite a lot of time to percolate into a larger segment of the population for leisure travel to pick up. Hospitality, yes, to some extent will start picking up because work-related travel may pick up. But what has happened is that the reset has happened because of the Zoom and the webinar culture. Is that I would say that today people have realized that how easy it is to do meetings without being physically present. So for it to come back to the old days of frequent travelers like myself coming back on track, I would say give it some more time. Now, so mid 2022 is a little bit early, maybe wait for another quarter post mid 22 when you will see the stock market pick up. But that sector itself, I would say only by end 2022 will those numbers start looking healthier. But the stock market will be a lead indicator and it will read the green signals, and the stock market valuation may start going up from the third quarter of 2022. So I would say play it according to that. The final question which I had pre-question is one about, will RBI extend the moratorium? When can we see BFSI pick up? I think I answered the BFSI question briefly. I'll answer it a little more deeply now. But before that, will they extend moratorium again? No, not at all. I think RBI's thought process is to do restructuring rather than extend moratoriums. And Kamath Committee has come up with the restructuring recommendations. I think more than 66% of all rated companies in India are going to benefit. Construction and all those segments which are in deep trouble will benefit. So I don't think the moratorium is the way to go. Restructuring is the way to go. Restructuring will be followed by bank recapitalization, bank mergers. So BFSI segment is going to see a lot of that. So the BFSI segments pick up. I think there's been a 1 month, there's been a pickup. I think that as a V-shaped recovery pans out, banks are sitting on huge liquidity. Deposit rates have been cut. RBI is giving them cheap money. 6 lakh crores of liquidity has been pumped in. They have still not lent out the drop in interest rates to the borrowing public. That will start happening gradually. And I think that in a recovery from the earnings perspective, I see that it will be in 6 months' time. But the stock market, for that to come back to the old valuations, because when you say BFSI pick up, I expect that you're asking me about the stock market valuation perspective. I think the economic recovery will be paralleled with the BFSI recovery. And so the best way to invest in that sector is through doing an SIP into financial services funds, right? So with that, I've done with the questions which have already come in prior to the start of the webinar. If some of you have posted any questions, I'll request my team to ask me those questions now.
Yes, sir. We've received a few questions. The first, how can we prepare for a black swan event?
So preparation for a black swan event comes from two perspectives. One is that, do you have a goal against which you have done your investment, right? So if you do, and I would recommend that everybody does every single investment with a goal in mind, then I would say give yourselves 2 to 3 years time before that goal date to cut it and move into liquid funds, bank savings accounts, bank funds. And so the one way to prepare for a black swan event is, if it is a goal based, you don't want to risk that goal actually happening, is to cut your position in that risk reward situation 2 to 3 years before that time, park it in safe and sleep peacefully. That's one. Second element of preparing for a black swan event is diversification. Never put all your eggs in one basket. Whether it's all in safety element or in risk, it's a risk. Diversification is the answer. So in the entire asset class space, I would say that at any given point in time, you should have investment in gold, investment in bank deposits, investment in bank savings accounts, investment in liquid funds, investment in medium-term duration funds, investment in small cap, mid cap, large cap, and diversified. So there's a lot of diversification, because that's the key. Because in these mutual funds, you'll get sectoral diversification. The only way to really prepare is, because in black swan events, for the month of March, you saw everything got hurt. But within a bounce back, you saw that certain sectors dominated. Can you predict what's going to happen? You can't. So I would say the single mantra for that is diversify your basket of assets across as wide a range. Actual rule of diversification says that up to 20, you get benefits of diversification, and after 20, that's the Markowitz hypothesis, it starts weaning away. So choosing the 20 diverse elements to put in your portfolio, how much in each is a function of your temperament. Because when you say I'm an aggressive person, it means aggressive means what? Not that you enjoy the high rewards. Everybody enjoys high rewards. It is your ability to suffer pain. What is your ability to suffer a loss for a period of time determines if you are aggressive. So the allocation would depend on your temperament. Aggressive, moderate, conservative. Don't go into much more detail here. Fit yourself into that. So if you're a conservative, then I would say at any point in time, 50% at least of your assets should be in safer ones which don't react to pandemics, like bank deposits, liquid funds, and all of that. 50. If you are a moderate risk person, that 50 can go up to 60, 60, 65 at stretch. If you're an aggressive person, you can put 70, 75. But be prepared that when the black swan occurs, you will suffer deep losses. But if you hang in there and don't panic, which is what an aggressive investor should do, then you will enjoy the rewards of recovery from the black swan much more than the others. I hope I've answered that.
Next question, sir.
Hmm.
Which funds to consider for 5 to 10 years?
So I would say that from a 5 to 10 year perspective, the before the SEBI regulation came, I used to say the multi-cap funds are the best because of the flexibility. But since the current regulation change doesn't allow that flexibility, I would say that a larger mid-cap and mid-cap are the two categories, right? Which from a 5 to 10 year perspective would do well, right? Now, what about the small caps, which I've missed out here? But large and mid-cap funds, SEBI says you put minimum 35 in large, 35 in mid. So you can still put 35 in small if need be. So that desired flexibility which was there in multi-cap has now shifted to large and mid-cap. Similarly, mid-cap funds also only 65% has to be in mid-cap. So balanced fund managers, those who have a balanced approach to it, will put about 5-10% in large caps and put 10-15% in small caps and keep 65 to 70 in mid caps. So if you stick to large and mid cap as categories from a 5 to 10 year perspective, you will definitely be in a good wicket. So allocate equally to these two segments, large and mid cap.
The next question, sir. Will tech and large caps correct after the US elections?
Not necessarily, because initially the market was worried about Biden coming to power. Right now, the opinion polls are saying that it will happen. And Biden was perceived to be more leftist, less pro-business, less anti-China, than Trump, right? But I think that the market is also getting pragmatic and realizing that what is said in the run-up to the election and what happens after the election can be very different. And the dynamic realities of the situation, I think, are something that Joe Biden, as a much more experienced politician and a pragmatic, given a month or two to settle down and put things in place, will by and large follow what an Obama administration followed, which was, I think, quite a decent thing. So I don't think that the large cap and IT is really going to suffer in this kind of a thing. I think Biden is much more open to an interdependent America in a leadership position as opposed to a aggressive, polarizing America as a superpower, which was Trump's vision. So I think an interdependent America will always be good for world economic growth. So I see NAFTA being revived. I see the NATO also getting strengthened. So I think the market will realize that, especially for countries like India, that a more balanced approach is something that is very good. So I don't expect any deep correction after the US election, which is when the IT and the large caps might get affected. My view is that the market will readjust. Short term, there might be a reaction, but you just wait it out for 2-3 months, it will all fall into place.
Um, the last question we've received, sir.
Hmm.
Are debt markets attractive now?
From a return view, the moment you use the word attractive itself, it makes me a bit worried, because debt as a portfolio allocation should be a safety oriented allocation. returns should largely be looked at from a risk reward perspective at equities. Debt does deliver rewards. I'm not denying that. When the interest rate moves are down. Now, what is the situation here? Already repo rate is very low. Maybe another 25 basis points rate cut may happen. Okay. Second is government's borrowing program has to increase to kickstart the economy. So when government is a borrower, it crowds out the private borrowers from the market, right? So if you then look at it from that perspective, if government is going to borrow so much, then long-term interest rates can't come down so much. So short-term repo rate may come down by 25 basis points, but a longer term, the fact that the government is borrowing means those interest rates will remain high and not drop as much. And already we are, sub 6%. What is the lowest we've been at 4? So to me, the shorter end of the debt market looks much more attractive because you will get some kind of a pickup from interest rate cuts, and you will get also a little bit of a carry in terms of the thing. But a very long end debt market, I would say closely watch the government's borrowing program and its impact, and that will then decide whether it will be. So I would still say, as far as a debt allocation is concerned, stay short term, right? So less than 1 year for your liquidity related debt allocation, and 1 to 3 years from a asset allocation perspective of getting some kind of a reward. So is it a good time to invest in debt? It's always a good time to invest in debt because, as I said, asset allocation and diversification have to be key part of one's portfolio. So don't ever take down debt to zero, right? Where I would be cautious on the debt side is on credit funds still, because Indian economy till it shows on a very recovery mode, I think there will still be negative surprises in terms of defaults likely to happen, and it's better to stay away from a pure credit risk oriented. Right? Thank you.
Thank you, sir. We have no further questions.
Thank you. Do stay safe and in this COVID environment, and look forward to our next question hour series in the month of November. Thank you and all the very best.